If you're a high net worth family paying over 40% in taxes every year, what I'm about to tell you might sound too good to be true. There's a way to potentially cut your tax bill without any ongoing time or effort from you. It doesn't involve risky tax shelters or aggressive strategies, and actually makes your financial life simpler, not more complicated. Most wealthy families think cutting taxes means endless meetings with accountants, complex business structures, or having to manage their own real estate rental properties. But the reality is the most effective tax strategies for families with significant wealth are often ones that work automatically once they're properly set up. My name is Samuel Harnisch, and I'm the founder of Quantitative Financial Strategies, where we help families with $5 million or more in investable assets preserve and grow their wealth through tax-aware investment strategies. And what I'm going to show you today is an approach to tax reduction that once it's implemented, it works in the background while you can focus on what actually matters to you. This isn't about finding loopholes or doing anything too aggressive. It's about using legitimate strategies that work better as your wealth grows, but that most high-income families never learn about because their advisors don't know how to implement them. If you've ever felt like tax advice is overly complex, you're not alone. Most CPAs are trained on compliance, making sure you file everything correctly and avoid penalties. While that's important, it's reactive, not proactive. When you start earning more or building real wealth, you'll notice something else. You get bombarded with complex tax strategies, layered trusts, entities on top of entities, and endless paperwork. A lot of these strategies work in theory, but in practice, they become a headache to manage. And worse, many fall apart over time because they require constant maintenance. Here's the key insight. The best tax strategies are the ones you can actually stick to. The wealthiest families don't necessarily chase the most exotic ideas. They prioritize simple, repeatable systems that can produce real tax savings year after year. They know the difference between tax evasion, which is illegal, and tax optimization, which is smart planning. And the truth is, you don't need 17 different trusts or a shell company in the Cayman Islands to reduce your taxes. You just need a thoughtful strategy that's built around your life that actually gets implemented and lasts. The first step is optimizing your portfolio. And in order to do that, we would just start by taking a look at your 1099s that you receive from your custodians for your investment accounts. And then we'd also look at the K1s that you receive from your private investments. Are they showing income and gains that are making you write checks to the IRS? And if they are, then that means you are not optimized. A fully tax optimized portfolio does the exact opposite. It's actually passing deductions to you that you can take every single year against gains and income that are happening outside of your investment portfolio. So when we look at the 1099s and K1s of these sort of investment strategies that we use, we would actually see a bunch of paper losses that show that you have a deduction that you're able to take. And you might wonder, how is that even possible? It sounds too good to be true. Well, it's just by using the latest strategies that are available. So whether that's tax-aware long-short SMAs that are harvesting capital losses, real estate funds that are made exclusively for taxable investors that are passing large amounts of depreciation, or tax-aware hedge funds that can pass ordinary losses which you can use to offset your income. On some of the portfolios I've taken over, we've actually gone from investments that were creating $500,000 in taxes every year to a portfolio that gets rid of that and actually passes a $500,000 deduction every year. And all of that while still making money and participating in the upside of financial markets. Next, let's talk about maximizing your business expenses. Most business owners miss out on hundreds of thousands of legal deductions that they're not taking just because they don't have a system in place. This section is all about proactively identifying every allowable business expense and tracking it properly so you can maximize your deductions without a fear of an audit. And here's what that can include. S-Corp optimization. You always want to start with the right structure, and an S-Corp could potentially save you thousands a year on self-employment tax, as well as open up the door to some more advanced deductions. Next, the home office deduction. Don't just settle for the simple $5 per square foot method. If you document actual expenses, mortgage interest, utilities, internet, maintenance, you can often deduct far more. Car deduction. If you've got an S-Corp, you can be leasing your car to your S-Corp as an expense every single month. And if you were to buy a new vehicle and it weighed over 6,000 pounds, you may be able to write off the entire cost in the year that you acquire it, making for a huge upfront deduction. Family integration. Pay your kids for legitimate work. Photo shoots, social media, cleaning up the office. You get to deduct the wages, and you could use the earnings for family expenses like travel, education, and Roth IRA contributions. Health expense planning. Set up an HRA or Section 105 plan to reimburse medical expenses. If structured properly, this can allow you to deduct out-of-pocket health costs through the business. And lastly, audit-proof documentation. And this is key. The IRS doesn't just care what you deduct, they also care how well it's documented. Do not DIY this. Work with a proactive CPA who knows how to structure this and keep records bulletproof. All right, next let's talk about supercharging your retirement accounts. Traditional retirement accounts like a 401k are practically meaningless to high earners because the contribution limits are just way too low to make a real dent in your tax bill. But there are smarter ways to supercharge your tax-deferred savings. One is the solo 401k. So if you run a small business or you're self-employed, a solo 401k allows you to contribute both as the employee and as the employer. That means up to $70,000 in 2025 plus catch-up contributions if you're over 50. And you also have the flexibility to open a regular solo 401k, or you can open a Roth solo 401k. And it's up to you every year if you want to contribute all to one account, all to the other, or if you want to do some sort of mix between the two of them. Next, you've got cash balance plans, and these are next level. You can think of them kind of like a pension plan for your business. Depending on your age and income, you could be contributing hundreds of thousands of dollars a year, all tax deductible. And lastly, you can actually stack these. So you could have a solo 401k plus a cash balance plan. And that's hundreds of thousands of dollars you could defer today, compound tax-free, and then potentially shift into lower tax brackets in the future, or convert to a Roth IRA paired with some sort of a deduction that we do with our investment accounts. That's hundreds of thousands of dollars you can defer today, grow tax-free, and potentially shift to lower tax brackets in the future. So the point is, if you're a high earner and all you're doing is using a regular 401k account, you're leaving massive amounts of money on the table. Now, before I show you the next strategy, I want to be completely transparent about something. These strategies aren't something you can implement just from watching a YouTube video or calling up your current CPA. They require differentiated access, proper documentation, and ongoing compliance to make sure everything stays bulletproof. At QFS, we specialize in this kind of tax-aware investing for families with $5 million or more in investable assets. We'll coordinate with your existing tax team to implement these strategies correctly and maintain them properly. If you're in that category and want to see what you might be missing in your current approach, the link is in the description. But let me show you this next strategy because it's the one that most advisors don't even know how to do. This one's all about the timing of when you recognize your income. So good tax planning is all about controlling when we recognize your income, if we do at all. So those cash balance plans that I was talking about are fantastic for deferring income in your high earning years, but that's really just a temporary solution where you've kicked the can down the road, where you've just deferred the recognition of that income. And the same is true for deferred comp plans or just large IRA balances. If I make a donor advised fund or some sort of charitable trust, then I can actually control the year I take a deduction, even if the donations aren't going out this year or even for the next 10 years. I can still get a deduction for it today. And we've also got these tax-aware hedge funds in people's brokerage accounts that are able to realize ordinary losses, which can be used to offset the income if we were to pull out some of the IRA account balances. So that cash balance plan that you have eventually gets rolled into your own IRA. And then when you go to withdraw from it, you could have some sort of an offset from a tax-aware hedge fund or a charitable donation so that you're not triggering taxes. Or even better yet, don't pull that income straight through to you. Do a Roth conversion instead, because you at this point will have millions of dollars in a deferred traditional retirement account. Well, if you structure things properly, you could move all $2 million or $3 million into a Roth IRA and shield those conversions from taxes with the tax-aware hedge funds. You might even combine it with some sort of charitable giving strategy. And I'd also add that if someone I'm working with takes a year off of work or they have an unpaid sabbatical, some sort of anomaly year where their income is far lower than what it normally is, that's a huge opportunity where we're going to pull forward income recognition that's been deferred in retirement accounts. Go ahead and take it now in this low tax year because we have a progressive tax system, and so you can be recognizing income at the very low tax brackets that otherwise, if you're recognizing it, you're going to be stacking on top of your ordinarily high income at the largest tax brackets. Most families think tax planning is just finding a good CPA and writing off as much as possible. But the truth is, people confuse preparation with planning. Most CPAs focus on compliance, so that means filing your taxes correctly and on time. Real planning happens before year end when there's still time to take action. And the goal isn't just to pay less tax, it's to build more wealth. Anyone can reduce taxes by giving to charity or just not making money, and that's not the goal. The best strategies let you keep more of the money that you're making so you can reinvest it and actually grow your wealth faster. If you have a financial advisor that focuses on tax planning and knows how to use the most advanced tax-aware investment strategies, that can make a huge difference. And when that advisor can team up with a proactive CPA, that's when things really start to click. So the most effective tax strategies for wealthy families aren't complicated schemes that require your constant attention. They're systematic approaches that work automatically once they're implemented correctly. The problem is most advisors don't know about these strategies or they're not able to access them. So wealthy families end up using the same basic tax planning that's really just designed for middle-class families. If you're tired of writing massive checks to the IRS every April and you want to see what sophisticated tax planning actually looks like, go ahead and use the link in the description to book a consultation call. We'll review your current situation and show you exactly where you could be leaving money on the table, and if you use some of the strategies we have, you'll be able to keep significantly more of what you've built. And even if you're not ready to make the change right now, you at least know what kinds of questions you should go and ask your current team. Make sure to subscribe for more videos on building and protecting wealth the way that sophisticated families do. And I'll see you in the next video.